Okay, this is my final installment of my four-part series on building and managing a stock portfolio. And this one arguably is the most important of them all, position sizing and risk management. It's a bit complicated to try and explain, but I'm going to do my best. There's a bit of math involved. But at the end of this, I've got a couple of tools that I'll make available to you if you'll find it helpful. So let's try and get into it. The first thing I always concern myself about is what is my maximum portfolio risk? And what this means is what happens if the shit hits the fan and I'm stopped out of all my open positions. For me, this risk in good times would be no more than 3%. And I adjust this depending on the status of the market. Currently, I'm right around 1%. If I don't want to exceed that, if everything stops out, the worst I'm going to get hit on my total portfolio is 1%. Now, this obviously presupposes that everybody's going to use stops. You absolutely must have stops for every investment that you have. Without that, then all of this is meaningless. So that's my portfolio risk. How much I'm willing to risk on each trade, for me, it's 6%. And that's a high number. I rarely do I actually risk 6% on one trade. My rule of thumb is I don't really want to enter the trade unless I'm going to get 3-1. So if I'm going to risk 6%, I want to get around 18% gain. At least 12 anyway, at least 2-1. And in this market, and it has been for several months now, pretty much all year, it's really hard to find those. And there's lots of them out there, but they don't follow my particular setups. So, but in normal times and with the longer hold periods, what have you, 6% is a reasonable number. Just as an aside, my average risk per trade for so far through the 10 months is actually 2.1% is what I initially set up as my risk. And the actual average loss is 1.7%. So I'm operating at significantly below where I would in good times. But that's a key determination to make as well. The third is how many positions should I have at any one time? And I argue that ideally it should be 4 or 5. More than that is difficult to manage. But if you have an account that's greater than $1 million, you could go as high as 8 to 10. I find having 8, 9 positions open is it's a little more stressful. With my style of trading, at least, every morning you're resetting your stops, you're evaluating where your stop should be. You're wondering where, so you got to be there when the market opens and it's just keeping track of 8 or 10, especially if things get volatile. It's a little more stress than I'm looking for. However, those are some guidelines. It should be noted that diversification doesn't protect you necessarily, whereas if you're concentrated, you get set up for meaningful gains. So if you have 4 stocks and the market is crap, odds are pretty good that all 4 are going to go down, but you may have a star amongst that so that you're insulated. And on the flip side of that, if the market is just cruising along, you could have one stock of your 4 that's really rocketing ahead 20, 25, 30%. So that's going to have a meaningful impact on your account balance. Whereas if you got 10, 12, 15 stocks, as some advisors would have you do, have like buckets of them, one stock doubles, it really, in your overall portfolio, it's a so what. So I prefer concentration. Again, this presupposes that you are absolutely regimented in having stop losses, because that's where concentration can hurt you if you allow something to go lower than 5 or 6% or wherever you happen to set your stop. And then I'll go over some of my rules when I should be fully invested versus, say, just putting a toe in the water. What kind of market conditions. So moving on. I'm going to start, my math assumptions are going to be with a $200,000 starting account balance. So if you agree with me that the maximum portfolio risk, if everything stops out, I don't want to be down more than 3%. So that would be $6,000. So you could, if you're going to take 4 positions, simple math says a full size position would be $50,000 with a maximum risk of 6%, if that's your maximum risk per trade. So you're risking $3,000 on that particular trade. Now, the trouble with that is to keep within your maximum portfolio risk of 6, you cannot take more than 2 trades where the full risk is 6% each. But if trade number 1 goes up and you can raise your stop to break even, then you've reduced your total portfolio risk to 3,000, and you can add another trade if the market conditions favor that. Or you could say, you could take not a full size position, but maybe a half position, a $25,000 position with a maximum risk of 6,000. And then arguably, or you do the math, you could actually take four positions at $12,500, at $25,000 each, rather. No, sorry, I got my math all wrong. I'm going to get to a chart in a second. Like I say, this it's a little complicated to try to explain, but again, it's bearing in mind you got to keep your total portfolio risk in line, and then each individual trade you must keep that in line as well. So I tried to draw. Oh, first off, I'll do my rules for how I position size and how much risk I'm willing to take. So if we're in an uptrending market with lots of good setups, my positions are working. God, I hope we get back there with like 2020. I will go to a 6% maximum portfolio risk. I'll be fully invested, and I might even use margin for more leverage. So it'll be pedal to the metal, full accelerator, let's go. In an uptrending market, but it's showing signs of momentum slowing, I reduce my maximum portfolio risk to 4%, but I'll likely be still fully invested. I just position size down a bit. In a choppy market, good setups, but mediocre results, I'm starting to reduce my exposure now to 50 to 75%, and keep my portfolio risk now to 2% or less. And I do that by lowering position size. In a lousy market like we've had now since, well, a whole year, basically since November last year, I lower my portfolio risk to 1% and keep position sizing small. And in these conditions, I'll rarely be more than 50% invested. So the whole notion here is when things are going poorly, you want to be investing the least amount. You're basically trying to survive and not necessarily make big gains. On the other hand, when things are really going well, that's when you want to hit the accelerator. And those times generally don't last for a long period of time, but you want to take full advantage of them. So how does this work? I'll start using the left-hand side because this is the environment we're in right now. So you should be with a $200,000 account, anywhere from $0 to $50,000 invested. In other words, from 0 to 25% invested, and sitting on 3/4 of your account in cash. You could break that up any numbers of ways, but I'll stick to having 4 positions. So if you're going to equally weight them, you're going to have $12,500 in each of 4 positions. If you have maximum risk on your total open positions is going to be no more than 3%, then you cannot risk more than $1,500 in total on your whole 50,000 that you've invested. Your maximum risk should not exceed $1,500. So if everything goes for shit and they all stop out, you lose the $1,500. The impact on your portfolio is only 0.75%. So that's, I mean, so easy to recover from. And then the maximum risk per trade at a 6% stop loss. In fact, in this kind of an environment, I wouldn't be using 6% as a stop. But if you did, your risk in that trade is $750. But since you're only willing to risk a total of $1,500, you can't have more than 2 trades at in this box that would risk more than $750. So I hope that makes some sense. It's like I say, this is a little complicated. There is some math involved, but the key things to zero in on is what's the total risk I'm willing to take in this market environment, and then how much am I willing to risk per trade so that I can stay within this amount. I'll show you how, there's a couple of things here. First off, to calculate your position size, let's, no, we'll do this one. I have a little chart, which I use all the time. So here, this goes back to how much you're willing to risk in dollar terms, but it also calculates it in percentage. But let's say you're willing to risk here $300 or $750, $1,250. You know, there's various. I've got this laid out. So depending on the market, right now, I'm in sort of in this zone here. This zone is comfortable. When things are getting good, I'll be out here somewhere. So what this does is says, okay, let's take this column here that's highlighted. I only want to risk $300. So on this particular stock that I'm looking at, and I don't even know what these numbers, what stock this was I was looking at, but the entry price was $25.10, or that was my planned entry price. I was going to break my stop into 2 places. Half of it was going to be at 23.60, the other half at 24.40. That calculates an average stop of $24. And so that risk is $1.10 off my purchase price, which in percentage terms is 4.4%. So that's definitely less than 6, so it's shaded green. And that means then I could take 273 shares. So my buy order would be for 273 shares at $25.10. If I didn't want to break the stop into 2, let's say the stop made sense to be the whole stop would be at 24.40. I just changed that. Now my risk is down to 2.8%. I'm still risking the same $300. And now I could take 429 shares, but I need a bit more capital. I need $10,757. So this is a quick and dirty way of calculating your share size before you get into it. That keeps you out of trouble and making a mistake. And then when I get out here, when it's red, that trade capital required, this means this is too high a percentage of my total portfolio. My total portfolio at the present time is $240,000, and since I'm not willing to risk more than $60,000 or put up more than $60,000 on any one trade. If I wanted to step it up here, this says that you shouldn't do that. So that's one little handy dandy tool. The second is what I call my exposure calculator. So currently I have 3 open positions. Here's the day I bought them, which is not that relevant. Here's what I paid for them. I put in today's price, which really doesn't mean too much. It does calculate an unrealized P&L out here. Here's how many shares I have. Here's where my stop loss price is. So then this calculates how the difference between my entry price and my stop is in dollar terms, and then it calculates in percentage terms. And then says, okay, my exposure, my dollar exposure on this trade is $1,750, even though that's only 3.6%. And it also calculates my position size, and then what is the percentage of that in relation to my total account. So I really don't want this in this environment to get more than 25%. So I'm within those limits. And then these two positions are small. They're only 5 or 6% positions, and the same math. So the important thing here is this line right here. So right now, if all three of these stopped out, I'm going to lose $2,050, which is 0.9% of my total portfolio account balance, which is within my tolerance, with my threshold. But it also tells me I really shouldn't be adding any new positions while I'm in this risk parameter. Hope that makes sense, and I can make these available to any of you that want it. So yeah, stop right. So like I say, this is a very difficult topic to try to communicate. I think if you do a Google search on stock position sizing, there will be lots of other articles and YouTube videos on it that probably explain it a hell of a lot better than I do. And if you have individual questions, I'll be glad to help you. Obviously, just reach out to me. And if you feel this tool or the share sizing tool would be of use to you, again, reach out and I can send you the Excel spreadsheets for these. So I hope this whole series was a benefit. And if so, let me know. That would be helpful. So with that, I'm going to end, and have a great weekend, everyone.